Well, it's a strategy investors have stood by for decades. Buy stocks for the long haul. Professor Jeremy Siegel of the Wharton School has been a champion of this strategy, and he joins us right now from Philadelphia. Jason Trennert of Strategas still with us. He's been writing about, quote, the death of equities. So this should be an interesting discussion because, Professor Siegel, I know where you stand. You're talking 15,000 on the Dow by year end. Did I get that right?
Next year.
Next year.
End of 2013.
End of 2013, 15,000 on the Dow. You're a classic bull. Tell us why, even in the face of all these concerns right now about Europe, we're going to get to 15,000.
Well, I think we would be there now if it weren't for two major concerns. One is Europe, as you mentioned, and the other is the fiscal cliff that faces everyone on January 1st. Now, I think that second one will be past it and that we're going to get some surprisingly good budget resolution in 2013. The euro, I have called for a last-ditch effort is that they're going to lower the value of the euro and flood the system with more liquidity. It's a mess in Europe. Listen, it's a total mess in Europe. But it will not spread to the U.S. as a Lehman moment, and I think when we recognize that, plus the fact that I think we're going to get some resolution on that budget front, I think even my good friend Jason there would have to agree that there are some very persuasive values out there.
But Professor, before we get to Jason and those persuasive values, I mean, yes, it is a mess in Europe. How can you say that this is not going to turn into a Lehman moment, though? How do we know that we're not going to see real bank contagion?
Well, first of all, there's bank contagion within Europe. And listen, if Greece drops out, I think there will be a banking panic. I think people will try to take their money out of, the Spanish banks, the Portuguese banks, maybe even the Italian banks. And the only thing the ECB is going to do is the same thing that the Fed did after the Lehman moment in 2008. They're going to basically have to say, hey, guys, I'm insuring all the deposits at this particular point. That's the only way to stop the run. And they can do that.
And if they do that, what do you think the timing would be? You think they will do that? What would the timing be, though? Because I think if they do that, everybody will go, oh, thank goodness. There'll be a huge sigh of relief, and the markets will just, push forward, thereby fitting into your thesis. But it's a question of when. I mean, when does Europe decide we're really going to come and save the day?
Well, personally, and it won't happen, I think, unless you get an accelerated run on the banks, or Greece suddenly drops out and converts euro deposits in Greece to drop. And the big fear of depositors is countries are going to drop out and convert all their money in the bank to local currency, which we know is only going to be worth 50 cents on the euro or about that. And that's why they're sending everything to Germany. That's why German, 10-year yields are down to 1.2, 1.3. The money is flooding to the center at this particular point.
Jason, do you agree with the professor that we can insulate ourselves here in the U.S. from Europe?
I do, and the purpose of full disclosure, I'm an enormous fan of Professor Siegel. I went to Wharton for graduate school. I wasn't a student of the professors, but I've since become a student of the professors. He's spoken at our conferences, and we've had him at special events. So I'm an enormous fan, and his books continue to be Bibles to me in a certain sense. I think what the professor is talking about, though, is it really comes down to structural reform of the structural problems that we have in terms of the deficit and the debt. I think if we get those, I would be the first to admit that equities are clearly the best asset class if you want to insure yourself against inflation over a very long period of time. What I'm worried about, and the problem, is that even among institutional investors that claim they have very long-term time horizons, the problem is, like Sinatra said, is getting through the night. 6 months can be a very, very long period of time, or between now and when the fiscal cliff gets resolved is a very, very long period of time, and you could see big losses between now and then. So I don't think the professor and I are really all that different in terms of our approaches. I guess my view is I'm not going to get really bullish until I see real evidence of structural reform.
Well, Professor Siegel, you make the comment with regards to the fiscal cliff that you think Congress is actually going to figure it out and accomplish something. And, of course, there are two aspects of it. extending Bush tax cuts and not going through that $1.3 billion of automatic spending cuts. So, or $1.3 trillion rather. So, lay out a scenario. How does actually all that happen so that we avoid the cliff?
Okay, I think there's two possible scenarios here. One is a scenario where they extend the current tax cuts again into next year so that the new Congress can tackle it and maybe a new president tackle that. Now, people say, well, what's the incentive for Obama to do that? Well, I think the incentive for Obama to do that might be because if they don't do that, and we're looking at that same cliff on the first week of November, you know, we could see the market down further. And, you know, this is going to be a very tight election, in my opinion, and I don't think he would want that. I think if he says, all right, let's come together, I'll do, you know, a 6 or 9 month extension till the middle of next year so the new Congress can deal with it. And, of course, he'll say, and I could deal with it, hoping to be reelected. I think you would see a big rally there. So I think there's an incentive on the Democrats to do that. Now, if that doesn't come about, there's going to be more nervousness. And I will admit, what Jason is saying, there could be a very rocky road with a banking panic in Europe, even with the ECB finally coming to the rescue, or we approaching that fiscal cliff. I realize that those are certainly pitfalls facing us. But I think that next year, with the new election, new Congress, and maybe the new president, or the public's going to say which vision they want, that is a time that Congress is going to get together and I think make surprising progress on closing the long-run deficit. I've been one of those that said, you're not going to get Erskine Bowles last year. I said, you're not going to get super committee this year because the election is coming up. So everybody has the incentive to say, hey, why should I bargain now? I think I'm going to be in a stronger position in January.
Okay, so
but
push will come to shove. By
January, everyone knows their position, and there's a great deal of push on the part of Americans and everyone else to let's get some deal done.
Professor Siegel, what about what helped the market rally today? And that's the expectation, the hope that the Fed is going to come in with another round of quantitative easing. Is that going to lend a helping hand to the stock market? Do you think we're going to get it?
It would, but honestly, I don't see that. I don't think our economy is weak enough to have another round, nor do I think, even though commodity prices have gone down welcomely, and I think that's a positive for purchasing power going forward, I don't think we have enough deflation. Bernanke doesn't have enough votes on FOMC now. Now, if the situation slows down more, if there's a euro crisis that threatens to, clearly spill over into the U.S. because the ECB isn't doing its job or something, then we got new cards on the table.
Professor,
but at this particular position here, we don't have a weak enough economy. We don't have enough deflation.
Professor Siegel says, no way, we're not going to see QE3. Jason, what do you say?
I say we're probably 1 week employment report away, which could be Friday, before we get it. And I think if we're going to get it, we're probably going to get it sometime in June. The next meeting, I believe, is 3rd week of June, June 19th, 20th, something along those lines.
Right around the time of Greece election.
Right, so you have all that to look forward to, but I think it's going to be very difficult. The markets right now are telling you, I think, if you look at the decline in bond yields, if you look at the decline in commodity prices, and until recently, the decline in stocks are all giving you deflation-type signals. I think the Fed has to be concerned about it, but I agree with the professor. I don't know how much good it's going to do, candidly. I think the real reforms have to come on the fiscal side, not on the monetary policy side.
Well, there is a knee-jerk, I'll tell you, and is a knee-jerk reaction that if they do announce QE3, I think you will see a big rally because in the previous easings, it's been associated with a nice rise. Now, I can argue cause and effect, and it's maybe just luck over here. But I think if he does announce it, and I don't think it's going to happen, because I think we have to see much more weakness. But if it does, that will, at least in the short run, really could pop stocks 5 to 10% upward.
All right, 5 to 10%. If we get QE, Jeremy Siegel says, though he doesn't think we're really going to get it, from the Wharton School. Jason Trennert, Strategas Research. All right.